Hello and welcome to Trading 5 Talents. In today's video, we are going to be talking about options Greeks. But before we begin, I just want to say I'm not a financial advisor and this is not financial advice. This content is for educational and entertainment purposes only. Any trades I mention are not trade recommendations, but either an example trade or a past trade that I've made. So please don't enter into any trades that you may see here. Let's get into the video. Options Greeks are 5 measurements that can affect an options price. And these are the main ones: delta, gamma, theta, vega, and rho. Now, you can see the Greek letters that are next to them. While vega isn't an actual Greek letter, it's usually denoted by a stylized V symbol, but usually you'll just see the names written out: delta, gamma, theta, vega, and rho. Let's look at the first one, delta. It basically asks the question, will it expire in the money or out of the money? And delta is how options premiums change relative to the underlying asset price movement. So for a stock, if that price moves, let's say $1, how does that affect the options price of that stock? And it ranges, the delta value ranges from 0 to 1 if it's a call option, or -1 to 0 if it's a put option. So for example, a delta of 0.4 for calls, obviously, it means that an option will move 40 cents for every $1 move in the underlying stock. So if a stock moves $1, options price would move 40 cents. If the stock moved $2, the options price would move 80 cents. You can also think of delta as a percentage of shares that you would own. As you know, that 100 shares are controlled by one contract, or one contract controls 100 shares of a stock. If you had a delta of 0.4, that would be roughly equivalent to owning 40 shares of that particular stock. So 2 different ways to look at delta, but it can also be used as a probability metric as well, and that's what I usually use it for. So a delta of 0.4 also means that there's approximately a 40% chance of it expiring in the money. So let's look at gamma, the second Greek. This asks the question, how is delta affected? So this tells us how much delta changes when the underlying price changes. So if you got a $1 move in the stock price, delta will tell you how much the options price will move. If you have a $1 change in the stock price, gamma is going to tell you how much delta will change, which will tell you how much the options will change. So it's a derivative of a derivative. You could think of delta, it's often explained like this: delta is like the speed of an options price, how fast it's moving, while gamma is the acceleration, so that rate of change over time. High gamma means that the option is more sensitive to the underlying movement of the stock. The third Greek is theta. This is an important one, and it asks, what is the effect of time on the options price? And basically it's a measure of how much premium the option loses per day, or how much value the option loses each day. The loss accelerates as the expiration date nears. So closer to expiration date, you're going to have higher theta. Further out expiration date, you're going to have a lower theta value. That is, time doesn't affect it as much because there's still a long time until this options contract expires. So for an example, a theta value of -0.3 means a $30 loss in option premium per day. Now again, when you look at these values, you have to realize that it is a multiple of 100. So a theta value of -0.3, one contract controls 100 shares, so we have to multiply it by 100. So -0.3 means $30 loss. It's negative. Okay, so a theta value of -0.3 means a $30 loss in the premium, and that's a per day basis, on a per day basis. This obviously works against options buyers. So you purchase an option, but it is decreasing in value day after day because of theta. But it's going to work in favor of options sellers because you want the price to decrease, or you want the premium to decrease every day. You are selling high in hopes to buy back low. Vega. What is the effect of implied volatility? That's this question, and that's what this Greek measures. And that is how much options premiums change when the implied volatility changes, or IV. All right, so the higher the volatility means the higher the option premium is going to be. Therefore, higher Vega means higher the option premium is going to be as well. You see this quite frequently around earnings. And so if you are selling options or buying options on the stock that has earnings coming up, you're going to see that the premiums of those options are going to be elevated because the volatility is going to be elevated. And the reason the volatility is elevated is because the earnings are unknown. You don't know if it's going to beat or if it's going to fall below expectations. So there's a lot of volatility, a lot of uncertainty. Therefore, the premiums are going to be higher. Once the earnings are then released, you'll see that volatility decrease. And then the option premiums go down. So if you purchased options and that volatility goes down, you purchased high and you're probably going to see a dramatic decrease in your option value now. If you sold the option beforehand, you would have sold high and now you're going to see that lower value of options, which is going to show a profit in your particular account. This is referred to as IV crush. So implied volatility crush. It's really inflated right before a binary event such as earnings or such as some news catalyst, and then it decreases dramatically once that news or earnings are reported. Finally, Rho. It asks the question, what is the effect of interest rates on the options premium? So how much does it change in relationship to interest rates? The value of Rho shows the premium change per 1% rate change. And the higher the interest rates means higher the options premium. So this one I don't use as much, and other people may, but of these 5 Greeks, there are really only 2 that I look at when I trade the wheel strategy. And these 2 are delta, because I'm looking for a value of 0.3 or less. That is, as an option seller in the wheel strategy, I want the options to expire worthless, or at least I want the options to decay enough over time that it's going to be out of the money when I purchase them back or when I let them go until expiration. Therefore, I'm looking for a high probability of it expiring out of the money. And that probability is about 70%. And so a 70% probability of it expiring out of the money means a 30% chance of it expiring in the money. Therefore, a delta of 0.3 or less. So the probability of 70% or higher expiring out of the money. And also another one I look at is Theta. Remember, this is the one that is measuring time's negative effect on option premiums. And I use it simply to estimate the time of the closing position. I don't necessarily make a trade based on Theta, but I like to look at it to know when approximately am I going to get 50% max profit or 90% max profit. So let me go over into the brokerage account and I'll show you where these Greeks can be found. All right, we are here in Robinhood, and this is the broker that I use to trade the wheel strategy. I just pulled up Workhorse, which is a stock that I used to sell options on quite a bit. I haven't done it recently, but this is a stock that I used to trade quite frequently. So if we look at Workhorse, the market is open right now, so it's trading right now at $11.27 per share. If we're going to go to Workhorse options, you click on the Workhorse options, and I'm only showing you as an example of where to find the Greeks here. So we're just going to click, let's get a higher priced option, let's say right here. So we click on this option. Let's just say this is the $11 call expiring July 30th. And right down here, you can see these are the Greeks: Delta, Gamma, Theta, Vega, and Rho. Now remember, Delta tells us the probability of it expiring in the money. So right now, 0.6117. So it's approximately 61% chance that it is going to expire in the money. In fact, right now it is in the money. And so that makes sense. This call is at $11. This share price is $11.29. Gamma tells us how much Delta is going to change. Theta is going to tell us the effective time on this particular option. So let's go to selling a put. If we were going to do this in the wheel strategy, let me just show you what it looks like. Okay, so we go to sell a put. Let's say we're doing it for this week. Share price is $11.25. What I would want to do is I would look for approximately greater than 70% chance of profit. So I For example, this is just an example, don't follow this trade, but this is one that I would be interested in. So let me click on this one right here. And you can see down here, here are the Greeks once again. And you can see the delta is about 0.25, so a negative 0.25. So this means it has approximately 75% chance of expiring out of the money, about a 25% chance of it expiring in the money. So what did our chance of profit look like? About 76%. So yeah, that makes sense. Okay, gamma, I'm not really too concerned about, but remember that affects delta. Vega and rho, I'm not really concerned about, but here's the other one that I am concerned about, theta. All right, so theta is the effect of time on the options premium. And you can see the value right now is a negative 0.0516. So if we multiply this by 100, as we have to do with all of these, that's going to be about $5.16 this option is losing per day. So let's just say it's $5. It loses $5 per day if everything were to stay the same. If Workhorse were to stay approximately at $11.29, where it is trading currently, this would lose about $5 per day. Now, you can see that the total credit would be 21 cents. And remember, this is per share, so we would get $21. Let's just say it's $20, okay? $20 credit we get. It is decreasing by $5 per day. Therefore, in 2 days, it should go down by $10, right? If it's decreasing $5 per day, theoretically, if things stayed the same, it should go down by $10 in 2 days. This is why I sometimes use theta to determine when I might potentially exit a trade. I'm looking for 50% profit on this. I'm selling it for $20. I'm going to exit when it gets down to $10. And it's going to get down to $10 in approximately 2 days based on the theta value. So I also want to show you how you can do it on your phone. So I'm opening up the search on Robinhood, type in Workhorse, tap Workhorse, go to trade, trade options, and then I'm just going to select the same strike price that we were looking at on the desktop, July 30th, selling a put and the $11 put. I tap on this. And then I can look under limit price and simply tap that, and you can see the Greeks at the bottom. You can also, if you don't want to add that, come back here under July 30th selling a put. You can just tap on the 40-cent credit or whatever the credit says, and then you can tap on that bottom down arrow, and you can see here the Greeks as well. So 2 places you can see it on mobile, and you can also see it on the desktop. So if you have any questions about this particular topic or about selling options in general or the wheel strategy, just leave a comment down below and I'll answer it as quickly as possible. In the meantime, if you want to learn more about the wheel strategy and how I use it for lifestyle trading, click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.